Okay, this is my last Q&A for the Market Outlook from Canada. It's the Tuesday evening before I leave. I leave Canada on Thursday. In 48 hours, the next one I do will be from Costa Rica. So enjoy. Let's start here. Not many questions this week. I think it was the long weekend. Appreciate you explaining our ABR's Form 4. Could their executive team be buying shares to support the price of the stock? Was the quantity of the purchase not high enough to materially support the price? No, this would not have been to support a price. When insiders are buying, it's a message to the market that they see value in their stock. Not only that, it's in the face of a short report, a terribly written short report that no serious investor would take serious. If any of it were true, insiders would be selling. If there was something there, certainly not putting between all of the insiders. I think you got to close to $600,000 of insider buys. You wouldn't be putting $600,000 of your own money at risk if you thought it was, if any of that was even remotely true. What are some of your favorite option strategies to utilize when IVP is this low, besides simply buying cheap calls and puts? Well, I don't know. IVP on the level of the index is low, but still on some underlyings, there is volatility still on some underlyings. So it's not something that would infect all stocks. Why do institutions like banks release their research reports on specific securities publicly for free that provide a buy, hold, or sell indicator? What's in it for them? Well, if I tell my clients, listen, we've done some research and we think stock ABC is a buy, and all the clients who want to buy. Now the real power is letting everyone else know. So if you're a client of mine, you'll get some research ahead of the market, and then at some point I'll release it to the rest of the market so that their buying can then push the value of the stock up, if they want to. I've been a viewer for some time. Some background, semi-target school, meet with many guys, lots of friends in MBS trading, many who I have trained in valuation at a university investment fund from BB, and interned at Fidelity and quant trading firm. We were managing 800K and it took it to 1.3 in 3 years. Funny story, we called 5.25, at least in rates in 2021, and saw the structural problems in the housing market in 2022 as well. I'm not seeking a career in finance, and I'm not going to try to be a trader through the prop firm virtual trading shadow industry. If I want to build a currency valuation model, that's a long explanation to ask a question about a currency valuation model for short 1 to 3 week and longer term positions. How should I go about building that strategy? With a lot of hope. There is no model for this kind of thing, because currencies are widely recognized as being a random walk. Sometimes they have a random walk with a drift component. But for the most part, they're random walks. I don't know that there is a valuation model. The most common valuation model is relative PPP is the most common valuation metric, but that is mid to long term. For short term, it is interest rate differentials that probably matter more, or the expectation of where interest rate differentials are going to go. Unless there's something going on in the world somewhere, then money will flow somewhere. Or maybe it won't. Or maybe it will. Or maybe it won't and something will happen. Or maybe something will happen and it won't. I mean, it's a random walk. So there really is nothing there. So I don't know that I would invest a lot of time and a lot of energy in building a model. You might find something in a currency, but then it doesn't translate to other currencies, which means you found something for that currency at that point in time over that look back period, and that's it. But beyond that, there's nothing. There's nothing there. I don't understand the logic behind the market rally from the October lows. Yields were dropping. Yields went down due to soft economic data suggesting future rate cuts. But even if this is the case, it would only be to maintain real rates at the same restrictive level. Okay, not to stimulate the economy. Well, the long end of the curve, the central bank has no influence over no direct influence over the long end of the curve. So it's not. It's the market that determines where those rates are going. So I don't know that the market is attempting to stimulate the economy. What do you think would be needed to lower the correlation between bonds and equities? Probably a market with lots of upside potential, or an economy with lots of upside potential, which means high unemployment, low capacity utilization, low corporate profits, a really high multiple on the market. You may think a really high multiple. What happens in contractions is earnings tend to drop, but the market tends to turn up before that. So you end up getting a very high multiple on the market relative to earnings, and then earnings catch up, and then the multiple. The market continues up, but because earnings are growing faster than the market is, the multiple drops. We don't have any of that. We have margins that are near record highs, or at least multi-year highs. You have earnings that are at record highs, or at least the forecast of earnings are at record highs. You have really low unemployment, high capacity utilization. So we don't have the conditions that suggest that the economy has a long way to go before hitting capacity. So until that happens, I don't know that you're going to get that negative correlation. A contraction, right away that negative correlation shows up. After watching your REITs explainer, I am keen to look into the industry a little bit more. Is there a textbook manual you recommend to further study the REIT industry? Yeah, there are literally, I'd say 50, 60 of them. They are, I'll give you the title of them, 10K. They're all labeled 10K, and then in front of it is the company, is whatever company name you want. And you have the 10K. You will learn more about the industry through the 10Ks than anywhere else. Start there. The 10K, that's all you need to read. 10:05, you explain rate cuts implied for 2024. Why do you extrapolate them out SOFR futures instead of Fed funds futures for 2024? Yeah, you can. You can go out to ZQ for 2024. But on the chart that I use for Fed funds futures, it only has the next 12. I would then have to find another, it's on from CME, you can find it's the same source, but you have to go to another place to find December's, whereas the SOFR curve is easy to find. The volume in SOFR futures is higher than those in Fed fund futures. So and they're almost identical because SOFR is backed by treasuries, short-term treasuries. So it's you get the same information. It's just it saves me clicking a couple more times and looking down and finding a futures price that has low volume and may not be the best. You can. I'm not saying you can't. You can. I just It's just more convenient for me the way I do it. How would you position yourself for an increase in volatility with a horizon up to 1 year? You buy options if you think there'll be an increase in volatility. I was thinking long dated calls in the VIX. Well, the VIX, long dated calls in the VIX. The VIX does not follow a no arbitrage price. So the VIX follows sentiment. So let's take, if you look at the VIX curve, if it's in contango, this is just where the market thinks it will be. So when you buy a long dated call, you're buying the call here, not where the VIX happens to be. You're buying it here, which means it has to, that the VIX by this point in time has to rise to this point just for you to break even and then rise further. Because these are not based on no arbitrage. It's based purely on sentiment. So long dated calls on the VIX. I don't even know if I would even bother with that. Puts on SPY are too much for my small sized account. Another option is to wait for the spike and then sell options. Anything else that could benefit from a VIX spike? Well, typically when the market goes, when VIX goes up, it's because the market is going down. So you just have to think about something that would go up when it goes down, and there are inverse ETFs, right? You can buy calls on inverse ETFs without having to buy calls on a VIX. You can do that. But don't use the levered ETFs. Just use a no leverage ETF, a one-time ETF, but just buy calls on an inverse ETF. Or find an ETF that does what you want to do. Bet on volatility. Find an ETF that does that, and you could be long the ETF. Regarding your ABR videos, how did you learn so much about CLOs, bridge loans? A great book, ABR 10K. They make a great series of books, the 10K series. You can find it on every single company. And there's a new edition out every single year. And then they have updates every quarter. They're called the 10Qs. And then if you go to their site, there's something called investor presentations, which augment the annual update to the books they put out. You see where I'm going with this? You need go no further than the very site of the company that you're interested in and start reading, start listening to the conference calls, and it'll all start coming into place. And whatever you're missing, there's this really funny website out there, funny name on it, Goggle or Google. I don't know if you ever heard of it, but it's got like this funny little bar like this and you can type in anything you want here. And you hit enter, and it searches the whole internet, and it comes back with a whole bunch of stuff. You can use that. These are fantastic resources that you can use. Obviously, I'm saying this in a sarcastic way because it's just so obvious. It seems that there's this desire to always want a textbook for something, and the real world is just so far ahead of the textbooks. If you want to learn about a company, just go right to the company's website in investor relations. Some companies have their own YouTube channel where they then have videos where they explain maybe part of their production process. Like Freeport has some nice YouTube videos explaining their mining operations in Indonesia. So you can actually see it, and they walk you through the whole process of here's the ore coming out of the mine, we bring it to the crusher, here's what the crusher does, and then they follow the belt and show you where it goes from there, and how the slurry is made, how it ends up in concentrate. So there's a lot from just the company itself. And then if you read a competitor's 10K, you'll learn a little bit more information. Then you read another competitor's 10K, you'll learn a little bit more. Then maybe you go to Goggle and you read a few other things that come up, and then the 10Q comes up. You listen to the conference call, and an analyst asks a question, which you go, yeah, what is that? And then you hear the answer, and it's you're not going to find one box with all the puzzle pieces for you. The puzzle pieces are scattered around the internet, and you have to go and find the puzzle pieces. And over time, you will find the puzzle pieces, and sometimes pieces you didn't even know you were looking for. Can you explain assignment risk and why is larger with high interest? Well, without using the Black-Scholes model, let me explain it to you in a nice, easy way. Let's take a timeline. On top of the time, there's your put, there's your call up here, your put, and let's say that you have a call and you have a put. You bought a call and you bought a put, and at the same strike price. The stock is doing this. The stock is going up, and interest rates right now are 5.5%. Right, this is going up. Well, the value of your call option will be the intrinsic value plus whatever time value you have left. So it's always worth selling the call rather than actually exercising it and buying the stock. Not only that, if you exercise it and buy the stock, you got to buy it over here. Well, you're going to lose this much at 5.5% because you don't have to part with the money yet, and it's earning 5.5%. You see that? So obviously, the assignment risk, if you're short the call, is fairly low for a long period of time, simply because the long holder can always sell the call and get the intrinsic value plus the time value. If they exercised the call to get the time value, they would have to stop making 5.5% on their money to own the stock. Well, the call has all the value anyways. If this keeps going up, the call captures all of it anyways. Why put money out and lose the 5.5? Now let's go the other way. Let's start dropping the value of the stock. You own the stock. Well, you can put it at any point in time. If you put it over here, you have cash. Now your cash can start earning 5.5% sooner. So it's a matter of when you receive or part with cash. If you exercise a long call, you part with cash sooner, you lose the opportunity cost of holding the funds. The sooner you exercise the put, the sooner you could start making 5.5% on the money as opposed to holding a stock that's dropping. So that sort of helps explain the assignment risk being higher, the higher the interest rate. When you have puts, the assignment risk with calls actually is lower, and the assignment risk with puts actually increases. Does the applied series satisfy CFAI's continuous professional learning requirement? Yes, it does. Just curious how you fared against the indices such as S&P 500, if you don't mind sharing. Well, I've explained this many times. It's not a fair comparison for me to say the S&P 500. Let's say that I bought a penny stock for a penny and it went to 10 cents. Would I then say I beat the S&P 500? Well, no, because this is not in the S&P 500. It's not a fair comparison. So another example is, let's say that I'm in a 100-meter race against a 5-year-old and I beat the 5-year-old like nothing else. Would I then say I beat you in a race? I mean, you're a runner, right? Well, I beat a runner, so I must have beat all runners in that class. I must have beaten you in a race. Yeah, but I didn't race you. I raced the 5-year-old. I didn't bet again. I didn't try to run with the S&P 500. I bought a penny stock. So if I'm investing outside of the S&P 500, is the S&P 500 my benchmark, right? So, but if you just want to look at it on a return basis, sure. I mean, I don't know that it's difficult to beat the S&P 500 on a regular basis. You're not going to beat it every year, but on a regular basis. This year, no. I took a big hit on beta, so this year, no, unfortunately. But it's really not that difficult. Give me the SPY. And let me invest in the SPY and let me sell 10 delta puts on the index, like really low puts that will never be put to me, and maybe I'll sell 10 delta calls at the same time that will rarely ever be called away. Well, I'll make some extra income and I'll beat the SPY. It's not hard to beat the SPY. It's not hard. You can do it. But the SPY does not have calls or puts. So you're going outside of the index to do it. To say that you beat SPY or the S&P 500, you would have to limit yourself to the stocks that are in the index. And then you would have to just buy those that you think will beat the overall index. And then you can say it was a fair fight. Then you can say, I'm so good that I restricted myself to the same stocks that the SPY has, and I still beat the SPY because I was able to pick the winners out of the SPY. Based on the... I've never heard of this letter, by the way. I did reply to this one, but I think it's important to point out what's going on here. Look what's going on in the statement, and when we read something fast, we sometimes end up in a conclusion that's faulty and then start thinking that that's the reality. New home prices have crashed 18% year over year in the U.S. Even the biggest decline in 2008 was 15%. New home prices are still up 24% to pre-pandemic high. Should this cause any systemic issues? New home prices can't crash. By definition, they're new. They've never been sold before. They're brand new. New home prices. I can't find 18% year over year anywhere. When you look at a new price index, I get a little under 16%. And during the 2008 period, they dropped by much more. I can't verify this person's information at all. So this is a new home. So 3 years ago, homes may have averaged 2,500 square feet with a finished basement and a paved driveway. And today, maybe to get a price down that is more affordable, they average 2,000 square feet with an unfinished basement and a pebble stone driveway, right? And maybe lighter on the landscaping. So that naturally would be a lower price than this one over here. So we can't say that new home prices have crashed unless we say, well, hang on a second. Let's look at what 2,500 square foot new homes with finished basement and paved driveways sell for today. That's the only way that you could tell. But if you say new home prices were this, new home prices were this, without accounting for the fact that most of these new homes are built to a certain price. So you're a customer, you go on to D.R. Horton's lot where they're building a new development, let's say 300 homes. You go into the model trailer, they got 6 different bills that they can do. And then you decide on what you want. So maybe this 3 years ago, it was this house here plus upgrades. And now it's this model over here, no upgrades. So yeah, it's going to be cheaper. But that does not mean it's cheaper than what this would have been 3 years ago had you taken this one 3 years ago. So because new houses can be made to a price. You tell me how much you want to spend, I'll build you a house. So last year, everyone wanted to spend $500,000. This year, everybody wants to spend $300,000. Well, I'll build you a $300,000 house. It's not going to be what the $500,000 house was. So you got to be careful about reading something and reading too fast. Slow down and be critical. You know, look at it and say, if somebody says prices have crashed 18% on new homes. Well, hang on a second. New homes now. Well, I know that new homes you can build to a price. So where'd you get your data? 18%. 18% where? In the U.S. That's not true. I can't verify that with any housing price index I found that is new, because I saw this and I looked at it and go, 18%, that doesn't seem right. So I looked around, I didn't find it. I found 15 point, almost 16%, but not 18%. So I would say whoever's writing this letter, I'd be a little bit more critical about the letter, and I'd certainly want to know where they're getting their data from and then check that data source. Sometimes You have people who have a story in their head and they want to tell you a story, and then they go looking for data to match that story. So if the data doesn't match, instead of looking at the median, they'll start looking at the average. And if the average doesn't tell the story, they'll start looking at the top 25 cities to see what's going on there. And if that doesn't work, they'll look at the top decile. There, look at the price down in there. Okay, there we go. There's the data I need to tell the story I want. So when they say new home prices, median home prices, average home prices, those are two different things. The average can be higher than the median. If you think that the top end of the market is less concerned, the cash buyers at the top of the market are less concerned, the average home price can be dragged up by big ticket price sales. So the average could be higher, the median could be lower, or could be the other way around, where you have a whole bunch of low priced new homes that are being built. You gotta tear this apart a bit more, right? But new, right there, it's like, okay, well, unless you're comparing house for house, you can't do that. Longest time no one cared about inflation, yields, and most of the Fed data because things never changed. Pretty much. I've heard other gurus say the same. Even Buffett used to say ignore the macro. Well, I wasn't saying ignore the macro. It's just 2013, 2014, 2015. Who was watching the Fed? The Fed was not going to change. Meeting to meeting, nothing ever changed. It was always, no change. It's like, well, duh. I mean, no one thought there'd be a change. What did they care about? Retail sales, durable goods, signals about the economy. That was, and earnings. That's what we should be focusing on, as opposed to the Fed. But we have so much focus on what the Fed is doing because the Fed pretty much controls the sentiment around yields, and yields pretty much control the sentiment around everything else. So we want to know what they're doing, but it would be nice to just put them in the back seat again. Were people busy looking at individual companies? Yep. I only got into the markets in 2019 trying to figure out what investing was like before. What would you have talked about on the market outlook, say, in 2015? 2015, what did we have going on? You had pretty much ugly prices going on in the grains, benign prices. And when I say benign, I mean really low on beef and hogs. Nothing exciting to see there. Oil had pretty much already given up the ghost, and had come down off the $100 mark after almost a decade there. Almost a decade there, except for a brief period during 2009 when it dropped down and then just went right back up again. It was mostly retail sales. China was always the conversation. Growth in China was always the big thing. It was always that. Currencies had some excitement there for a while. Once you got past, I think, 2013, the US dollar started to gain strength. Well, I don't know if you'd say the US dollar gained strength as much as other currencies started to fade away. That was kind of a big thing. It's hard to remember exactly what was going on, but I don't remember the Fed being a thing. I don't remember ever, Fed meetings would come and go and be like, oh yeah, today's a Fed day. It was, it was will this be the first time we don't see a recession after the inversion of 3-month 10? I don't know. I don't know. We'll have to wait and see. Beats me. And why or why not can't be answered until it either does or does not happen. 30 years old, work as an engineer, make roughly 140, 150. My career earnings are tapped around 200 in my current industry. I hate my career path, and finance has taken a huge interest in mine. Following the economy, reading, investing, trading, macroeconomics, trading, investing, watching YouTubers like that. How can I learn to do a career switch? Whether it's getting a master's in finance smoothly as to not take an early hit on my current compensation. And switch into an industry like wealth management. Wealth management, you're not going to start at 150. You got to build a clientele. You got to build a book. Banking. If you're an engineer, you're 30. It depends on what kind of engineer you are. Probably the CFA would be your best route. CFA combined with an engineering background might make you, valuable for your industry knowledge in a particular industry. Again, depending on what kind of engineer you are. Any advice would be appreciated, whether it's pointing me to a specific website, path, school. I don't know that I would bother with another school. If you say that your earnings are tapped out at 200K, maybe layer on an MBA on top of that, and that would then makes you promotable within the organization you're in, or the CFA. If you want to actually just leave engineering altogether, that might be a place to go. New home sales down as well. Yep, those rate buy downs and other incentives can only do so much. Let's see. If I buy the applied series now, how long the access lasts? Will I get new content? There is no expiration on it, and yes, you do get new content. 12/31/2024 operating earnings are 242.72. So will that make things a bit rosier? I don't know. You're skipping a quarter. I don't know why, but you want to skip a quarter and just say ignore the next quarter and let's just take the next 5 quarters, and we'll take the back 4 of the next 5. To know whether or not that's a good multiple, you would have to compare it with every other time where you ignored the next quarter and just jumped ahead. So we look at the next 4 quarters. Because 1, 2, 3, let's put 4 quarters in there, because we look at the forward 4 quarters. If we say, I don't want to look at this one, I want to look at this one over here, then you'd have to compare the multiple with every other time. So you'd have to go back, and instead of looking at the forward multiple and comparing this multiple relative to all the others, you'd have to create a whole new multiple stream that consistently skipped the very next quarter and looked at the next 5 quarters minus 1. Never heard of that, but I guess the question would be, well, why just skip 1? Why not skip 2 and look at the next 6 quarters minus 2? And if you want to make the earnings look even better, why not just skip the next 3 and look at the next 7 quarters minus 3? If you really want to make it look good, why not just skip the next 4 and look at the next 8 quarters minus 4, because the earnings do this. And in fact, why even stop there? Why not just go to 2030 and look at what earnings are there? You see what I mean? Why skip 1? Like, you want to skip 1, which seems rather arbitrary. Why not skip 2? Why not skip 3? The number will just get higher and better. But if you do that, you must create a new multiple series of the forward 7 quarters minus the first 3 to be able to compare whether this period of time is relatively more expensive than any other period of time for the periods that you want to look at. PCE will come in fairly benign. What does that mean? Does that mean that PCE will be slightly below 3.4? Benign means that it won't be showing signals of re-accelerating inflation. It will follow CPI in being, to either as expected or lower. And I think PCE will come in the same way. Why NVIDIA shows FY24? Does it mean the year 2024? It's the year in which their 4th quarter ends. So for companies whose 4th quarter ends December 31st, that would be FY23. For companies who have, let's say, a January 31st year end, that would be FY, the full year, fiscal year ending 2024. Is Mark still an ABR bull? I wouldn't say that I'm bullish, but I'm certainly not bearish. That short report did not shake me at all. As I started looking through it, I thought, okay, well, this is just bullshit. It shows a general lack of understanding of their business model altogether. So it didn't knock me out, but yeah, you got to live with the fact that the price goes down for a while. But fundamentals will bring it back up again. I think if the 10-year starts printing a three handle, 3.9x, and then you see it moving down, yeah, I'd probably get more bullish on ABR at that point. But I'm not bearish. I'm not selling, but I'm not bullish in the sense like, oh, it's going to $20 tomorrow. It's interest rate dependent, and it is going to depend on where the 10-year goes. To determine how much of the loans in those CLOs will migrate to the GSEs, and under 4%, the CEO believes that kind of activity will explode. His words. You'll see. He says under 4%, you'll see it explode. There, I would probably say, okay, if it's still sitting at the $12 range when the 10-year prints a three handle, then yeah, I probably want to buy, 10, 15,000 shares, without blinking. And there we are.